Hey everyone, welcome back to the next content about Howard Marks' investment philosophy or investment method. And who is Howard Marks? Like he's actually a very renowned and expert in finding the cyclic nature of the market. Even Warren Buffett used to eagerly wait for his memos to read what is his point of view on the current trends of the market. So such a very interesting and talented person, and his book is about predicting the market. Is one of the awesome book. You all should read that book to get more insights from Howard. So let's get some few tips from Howard Marks about investing and what to, if you are a beginner to investment, you are at right time, you are at right place. So this opportunity nobody, like most of the people, doesn't get. Even when I was there, when I started my investment journey, and nobody was there to guide me, or these kind of YouTube channels were not there at that point of time. So everything we learn by ourselves, by experiencing all the pain by ourselves. So now, because of this kind of a YouTube content, you are getting so much valuable insights. The book which I'm talking about is a wonderful book. You don't need to read if you are going to watch this video. So this video is going to give the top 5 key points or key things from Howard's method. So let's get into the detail. So this is Sundar and you are watching Mindful Finance. The first point from Howard Marks is the best one. Don't predict. This is the best point. Like you can write in a big wall. This point is like nobody accept. That is a very big thing in the world. Don't predict. Howard Marks has a very good golden rule, which is don't waste time by trying to predict the future. Instead, focus on what is happening right now. For example, if you are getting into a construction building, or if you want to buy a flat or something, right? And when you visited that place, it was during the foundation phase. Assume that it was a foundation phase, and you see some cracks happening on the pillars and other things. What do you feel like? Will you wait for what is going to happen in the future, or when this building is going to collapse or anything, or you just avoid to buy that home? Right? Obviously, the second one is everybody selects. So similarly, Howard focuses on taking the temperature of the market to understand whether it is overheated or full of hype. So he makes sure those kind of a scenario, like to be cautious. And is it the market is the current situation is whether it is a freezing cold with no one willing to invest. So that's when you should pay close attention. If you check the COVID-19 crash during the March 2020, the market tanked during the initial days of the pandemic. Some investors panicked really, but those who stayed calm and invested when things felt frigid saw massive gains as the market rebounded. The second one, the best time to act is when others are panicking. So similar way, Warren Buffett also used to say that when there's a blood in the market, you have to be in that market, right? So in 2008, during the global financial crisis, most investors were running for the exit. Like big banks were collapsing and it seemed like the financial system would fall apart. But Howard Marks and his team saw it as one of the greatest buying opportunities ever. Imagine a massive traffic jam during heavy rain and everyone is frustrated, switching lanes here and there and honking. But the calm driver who stays focused and avoids unnecessary lane change usually gets through faster or in a peaceful way. End of the day, the journey is the end point. Everybody is going to reach the same place, right? So let's enjoy the journey. Don't get panicked. So the main lesson over here is when others are panicking, staying calm and sticking to your plan can lead to best outcomes. You can take an example of real estates also. In real estate, when temporary panic causes prices in good areas normally drop, but the calm buyers often get the best deals. Once the dust settles, those investments become gold. I remember during the time of 2008, the major crisis happened in Bangalore. All the apartments were selling cheap and nobody was actually ready to buy. Yes, the real estate has fallen so badly. It affected a great number of people, but there were smart people in my friends surroundings. They bought very cheap. Like during the Marathali area, people bought flat for 12 lakh and 13 lakhs at that point of time. It was selling for 18 lakhs, 20 lakhs, dead cheap flats you used to get at that point of time. So that is the main thing. Like you should not panic when things are looking like a saggy, complicated, or like a blood in the market, right? When everybody is selling, market is going down. So don't get panic. Those are the opportunities. And the third one is valuation matters. So don't overpay for shiny things. As I mentioned, like during the dot-com bubble also, whoever like own a tech company used to make mint a lot of money at that point of time. The worst part was simply you create a .com domain and your stock gets listed in the Nasdaq or S&P 500, and that was funny thing at that point of time. Without any kind of a valuation, the stock price used to go skyrocket. So one of the most famous cases was pets.com, which raised millions despite having no profit at all. When the bubble burst, pets.com went bankrupt within 9 months of its IPO, and investors lost everything. Similar thing happened in India during the time of 2008. Satyam Computers was once considered one of the India's top IT companies. It looked like a star performer, but behind the scenes, its financial was manipulated. In 2009, the truth came out. Ramalinga Raju was in the background, like playing, manipulating the market. So Satyam's profits like crashed like anything. There was no cash reserves at all, and the stock price crashed 80%. In just single day. That was a historical thing happened in our Indian market. Like 80% fell, wiping out billions of investors' wealth. So the key lesson over here is, so just because something is popular and shiny doesn't mean it's worth the price. Always check the fundamentals before investing. It's a very, very, very important point. Don't ever get into investment without understanding that fundamental of that company. If you don't have understanding of that fundamental of that company, don't even enter into stock market. This is very, very important point. The points I'm discussing all are key points which you have to write down and memorize. It has to be like a checklist. You have to check whenever you are trying to buy something. The fourth key point is emotions are your enemy. Whatever there is saying, right? Whatever you decide when you are very happy or very sad, it's a bad decision. It's going to be a bad decision. If you are going to do a shopping, just like suddenly you feel like I want to buy some iPad or something, right? What you have to do is add that iPad in the Amazon your shopping cart. Wait for 1 or 2 days. And then you yourself will realize that, okay, this product is not needed for me. Why I need to buy, right? So don't take any kind of decisions when you are in an emotional mode. Like for example, in the roller coaster ride, see the emotions in investing are like rolling around, riding a roller coaster thing. At first you will be like excited, like wow, I'm going to have adventurous thing today, and you'll be very excited and confident. But as the ride gets through, it becomes rough, and you get fear, and you're feeling like you're puking out. You want to immediately like stop the roller coaster and get out of it, right? But key stay is be calm, relax, and just enjoy that moment. Because ultimately, at the end of the day, you want to have fun. You need to enjoy it. You need to feel that fun. That adrenaline has to be enjoyed, right? Instead of that, you got panic and you got shock. You want to get out of it. So that is the time you have to be focused, calm. Whatever it means, ups or down, markets are always volatile. Doesn't care. You should not worry about that at all, right? So you know the company's fundamentals. You had a valid reason why you entered into that stock or you bought that stock. Now, since you have a clarity, you know that if it goes down, you want to add some more. Instead of having a confusion of whether to get out of it, you will add extra over there because you have confidence. You know the company, you know the management, you know the business, right? So that's if you remember, that's a company called GameStop and AMC Frenzy. Lot of people bought these stocks at sky high prices out of FOMO, like fear of missing out. The hype died down. Those who bought at the top suffered massive losses. Even the similar thing happened with Zoom during the COVID time. It went like anything. and then the same way it fall, right? So here the Howard's advice is buy low, sell high. It might be very easier to say, but then doing it in a reality, right? But it's the only way to win. So this is the very key point. You need to understand that. Understand the valuation of the company. Understand when to enter, whether the valuation of the company is good or at the low. Is it the right time to buy? Understand the psychology of the market and then enter rather than taking emotional decisions. The another fifth point is I'm a fan of this actually, which is dare to be different or be a contrarian investor. So to succeed in investing, you must be bold enough to take a different path from the crowd, because just understand one thing: market is something that the things happens very early. If you and me get a news or get a thing about a certain company, we are actually getting that news after that incident had happened. Whatever things we got to know now, already market would have factored or known by someone, and those things are done and dusted. So we will be getting late into the late in the game. So in that case, kind of a thing, you need to be thinking different. If everybody is trying to buy some stock, you have to think whether to buy it here or not, right? Because everybody knows this thing means, so something has happened earlier. That is already factored. Now if you go and buy, that means you are buying after the incident had happened. So don't do that. We have to buy before the incident are happened or going to happen. So that is where the Howard is expert in. He knows the cyclic nature of things. He knows what is right now happening rather than like predicting what is going to happen. He knows now what is happening. Is it right time? So imagine visiting a popular tourist spot. The main viewpoint is always crowded and noisy. But if you dare to take the less traveled trail, you might find the most beautiful and peaceful view. I really experience whenever I go for any kind of a tour, or if I visit any place, I don't like to go where people are already talking about. It happened in multiple places, in Nainital, in Kerala, Palakkad. Like you, if you go and ask the local people, they'll give you a place which is not seen by anyone. So So during the pandemic, stocks of travel companies like Marriott and Airbnb, Indian Hotel, they crashed like anything. So while most people avoided them, some brave investors bought during the dip. Once the world reopened, those stocks soared and rewarding the contrarians. So the lesson here is being different is uncomfortable, but it often leads to a best opportunities. The next most important thing, the sixth key point is survival comes first. You have to play defensive, not aggressive. Howard Marks' number one rule is to survive first. No matter how great your strategy is, you won't succeed if you can't survive the tough times. Example, in the football, a great football team doesn't just focus on scoring. It builds a strong defense. If you can stop the other team from scoring, you always have a chance to win. Tata Motors faced tough times but stayed conservative with their finances and avoided major risks. So their survival strategy paid off, helping them bounce back stronger. On the other hand, Lehman Brothers collapsed because they took on too much risk without protecting themselves. So the thought here is always manage your risk. It's okay to miss some gains as long as you protect yourself from major losses. So the final thought here is always manage your risk. It's okay to miss some gains as long as you protect yourself from major losses. So these are the powerful lessons from Howard Marks, and these are like timeless strategies. It can do miracles. It doesn't matter what time it is. It works. This principle works at any point of time. So that is the greatest thing about Howard Marks' point of views. So just remember, don't predict, understand the present. Stay calm when others panic. Focus on value, not hype. And most importantly, always protect yourself from big risk. And if you found this video helpful, don't forget to like, share, and subscribe. See you in the next video. Thank you so much. Have fun.